life insurance to their employees. And typically, the amount that you see is $50,000. The reason for this $50,000 is that any amount in excess of that $50,000 might be taxable. In order to avoid that taxation, you could make the beneficiary your employer, which most people don't do, but that would avoid that tax implication. Another option would be to give that excess to charity, and if you do that, excess coverage is not taxable. If the employee is disabled, excess coverage is not taxable. If you are looking at tax implications, what you need to do is check out the Table 1 rates. With the Table 1 rates, you're basically looking at the amount in excess of that $50,000, which is that magic number. And if you look at the bottom of the screen, you can see the actual calculation. Note that the different ages in the table, as you get older, it costs a little bit more. And this cost is per thousand per month. So with the example I have below, I have somebody who is, let's say, 26 years old, somewhere in that 25 to 29 age category, which means they're paying 6 cents per month for each $1,000 over that $50,000 limit. Walking through that calculation, I've assumed he's got $250,000 in coverage, which means, starting on the left, $250,000 minus $50,000 gives him $200,000 in excess. Divide that $200,000 by 1,000 to see how many thousands we have that cost per thousand, and you have 200. So there's 200 times, with him at 26 years old, is 6 cents. 6 cents times 200 gives us 12, times the 12 months for the year, and that final 12 is usually what tricks people up. They'll forget to make it per month, and they'll just give one amount and stop at that 12. So the 12 that we had times the 12 for the 12 months in a year gives the cost for $200,000 in insurance, that excess over $50,000, at $144 in taxable income to that employee.